Ever wonder how billion-dollar companies like Apple, Tesla, or Meta track their money? Understanding financial statements is not only for accountants. It's very important for you to run a business, understand an investment, and also catch a fraud before it's too late. In this video, you will learn the 3 essential financial statements: the income statement, the balance sheet, and the cash flow statement, the key difference between financial and managerial accounting, a real-world example of breaking down Apple's 10K report, where you can find their annual financial statements, and how companies manipulate financial reports and how to catch them. If you want to invest smarter, avoid financial traps, or just sound like a pro when talking about business, you need to watch this video. So let's get into it. So first things first, what is the difference between financial accounting and managerial accounting? Financial accounting has the purpose of showing external users, people that are outside the organization, how the company is doing. So the financial statements are nothing more than reports of how the financial situation of a business is doing. On the other side, managerial accounting is for managers. It's a different type of accounting that they use to make decisions on financial planning, on inventory, and other things that outsiders don't need to know at the moment, because you don't want the competition to know how you're managing at that particular second your business. And that's why us investors only have access to things that are created by the financial accounting team. This is the 10K reports, the 10Q reports, and other reports and disclosures that we as investors, outsiders of the organization, have access to. Let's get into the 3 main financial reports. And here we are in the middle of the Amazon. No, just kidding. I'm in my local park. The income statement is like this river right here. We call it a flow statement. Why? Because it flows. It's like a river. You can imagine that place to be the start of the river, so it symbolizes the revenue, and everything flows, the money flows, and you have expenses, you have salaries, you have different things like taxes, all the way here where you can see it's like the net income, where the river stops. And then we have the balance sheet. As you can see, the balance sheet can be represented as a tree. It's a stock financial statement. What does it mean by stock? It is like a picture. Like this tree is not flowing, there is not a movement. When you're reading a balance sheet, it's like this tree. At this precise moment, you can see how it looks. It's the same thing with the assets they have at that particular moment, the liabilities and equity that they have at that particular moment. And finally, we have the cash flow. From that river that flows and the money that is made, some of it is not actually cash. The cash flow statement is like the roots of the tree. It's the most important thing. It takes from the income statement some things like the water and nutrients that gives life to the assets, to the liabilities, and to the equity. The cash flow statement is the most important because it shows you when money is coming in and money is going out. And when I say money, I mean literal cash. The most important thing, how much cash it's generating and how much cash it's spending. Good businesses have a really good flow in the income statement, a strong balance sheet like this tree, and strong roots generating cash flow that is growing and is steady. This is the perfect analogy for you to understand why it is important to analyze and have a good basis of what financial statements are and what financial accounting truly is. Let's get back to the studio. Let's apply what we have just learned to a real-world example: Apple's financial statements. You can find Apple's financial statements just by typing Apple 10K report 2024. The difference between 10K, that's the annual report, and 10Q, those are the quarterly reports. So you will have one 10K every year and 4 10Qs every year. As you can see here, you will most likely have a link from the SEC, which is the Securities and Exchange Commission, which is the financial supervisor of the United States, or from their own investor relations website. And this is how a 10K report looks like. It has a lot of information that could be useful, but today we are only going to look at their financial statements. As you can see here, financial statements and supplementary data. You have a consolidated statement of operations, a consolidated balance sheet, and a consolidated statement of cash flows. So let's start with the consolidated statement of operations. That is something like the income statement. Why? Because we have at the top net sales, and then at the bottom we have net income. This income statement, as we have seen, is like a river that is flowing from revenue, the things that they are selling, the iPhones, the iPads, the iMacs, all the way to net income. What is the accounting money that is left to the investor? So we can see products, services, and total net sales. Products will be an iPhone, iPad, or Mac. Services, their Apple Music service or their Apple One bundle. Then cost of sales, you have the cost of sales of the products. How much does it cost to have the materials, the camera, the cost of sales of the services, how much does it cost to maintain the website, how much does it cost to maintain the database and all of that stuff. And the gross margin is simply the difference between the revenue and the cost of sales. And on the right, you can see that you have 3 years. You can compare how the progress of net sales or net income has been doing from 2022 to 2023 to 2024 in order to make a more informed decision. After that, you have operating expenses. You have R&D, also known as research and development. How much money is Apple doing in order to innovate, to have better cameras, better software? Selling, general and administrative, people that are selling, the people that are developing, the people that are in charge of making the company work. Those salaries, those wages, those things are in this line right here. And you have the total operating expenses. The difference between gross margin and operating expenses will be the operating income. And then you have other expenses like income from investments or paying interest. After that, you will have income before taxes. Then you have a provision of what you will pay to the IRS. And finally, after paying everything, the employees, the interest, and the government, you will have the net income. This is very important because with net income, you can calculate earnings per share. As you can see here, earnings per share is basically how much money is left over divided by the number of shares that the company has. Where can you find that information? At the top of the report, you will find numbers of shares at this particular moment. If we go all the way back to the top, you can find it right here where it says 15 billion shares of common stock were issued and outstanding as of October 18, 2024. Then we have the consolidated balance sheet. This is the picture, the financial situation of Apple. You will find current assets, non-current assets, current liabilities, non-current liabilities, and the shareholders' equity. This sounds complicated, but it's actually pretty logical. Assets are simply the things that a company owns or has a right to exploit to get money today or in the future. Liabilities is the total opposite, things that you owe, things that you have to pay in the future, things that you have been paid in advance, things that you have to give to somebody else in the future. And finally, the shareholders' equity is nothing more than what you own minus what you owe. What is left over, that's your equity. And as you can see, we have current assets. Current assets, it means that is more easily convertible to cash. Cash is cash, so that will always be the first thing in the balance sheet. Then marketable securities, it is pretty easy to sell. You just sell with your broker and you'll have cash. And you go all the way until you have your most illiquid assets. For example, selling a plant or equipment or an entire building is not as easy as selling a share of stock. So those will be non-current assets. And the same thing applies with liabilities. You have current liabilities. So short-term obligations like paying your providers, suppliers, that will be a current liability. But paying the loan that is for 30 years, the 28-year balance that you have in the future, that's a non-current liability. So as you can see here, current assets, we have cash and cash equivalents. Cash equivalents means short-term treasury bonds that are almost the same as cash because you can easily sell it at any time the market is open. Then we have marketable securities. These will most likely be bonds or stocks that Apple owns. accounts receivable are things that they have sold prior to receiving any money. Then we have inventories. This will be all the Apple products that are in the inventory and that have not been sold yet. And then we have other current assets that you can check in the notes of the financial statements. Non-current assets, we have marketable securities. Why do we have marketable securities both in current and non-current? Because there may be some marketable securities that are easily convertible to cash, like a share or a bond. And maybe these non-current assets are marketable securities that are more in the long term. So a bond that has a 20-year maturity will be closer to a non-current category than a current category. Then we have property, plant, and equipment. Net, why does it say that it's net? Because you are discounting the depreciation of that plant, of that property. And that's why it's called net. And then we have other non-current assets. The same thing applies with liabilities. We have accounts payable, things that we have to pay in the future, short term to suppliers. We have deferred revenue. This is things that we have received prior to giving an iPhone. On Apple's latest iPhone launch, they could say this new product will come in 2 months, but you can buy it now. That is deferred revenue, things that you receive, but you haven't given out the product yet. So that's something you owe, something you have to give, and that's why it's a liability. Then you have commercial paper. This is kind of like a short-term bond. And then we have term debt, which will be short-term part of the bond. So the bond will have different payments. The payments that are for this year will be here in current liabilities. And as you can see here, we have the same name, term debt, in non-current. That is the next 19 years of payments. So you divide that term debt into short-term and long-term in the balance sheet. And then you have other non-current liabilities and the total. Finally, we have shareholders' equity. You have the common stock, which is always a symbolic number of how much does the capital in paper cost. Then you have accumulated deficit or accumulated revenue. These are what you have made, all the net income that was produced in previous years. You add all of them up and you put into this account in order to have a picture of how much did the initial capital grew or decrease during the life of the business. And finally, you will have total shareholders equity, 56,000, and always the number that is total assets has to be equal to total liabilities and shareholders equity. This is an identity. It has to be always in that way. If those numbers are not the same, then somebody messed up or it is probably a fraud. And finally, we have the cash flow statement. In my opinion, this is the most important financial statement. Why? Because the income statement has non-cash movements. So depreciation, that's not really an expense because you haven't paid out cash to anyone. But here in cash flow statements, this is a statement where you only look at things that have come to the business in the form of cash and that have left the business in the form of cash. And you as an investor, the only thing you care about is how much cash flow is the business generating for you. You don't care about how much money in paper in accounting have been lost to depreciation or anything like that. You care about how much money in a year has the business actually made. The cash flow statement is divided into operating activities, things that the business is made to do, investing activities, things like investing in capital for plants or property or buildings. And finally, we have financing activities, things like borrowing more money or paying dividends, or asking for more money in the form of selling more stock. So as you can see here in operating activities, you always start with net income. There are two ways of doing the cash flow statement, but usually you have the net income as we have seen in the income statement. Then you have to adjust for all the things that are not cash related. So the depreciation, the amortization, all of those things have to be added back to the net income because those were not actually cash expenses. Then you have changes in operating assets. So the changes in account receivable, in inventories, in accounts payable. What does that mean? That basically means that if you have more accounts receivable from one period to another, then you have less cash. Why? Because accounts receivable, those are sales that you haven't received cash in exchange of the product. If you have more of those, that means that the consumer has more debt with you. On the other hand, if you have more accounts payable, that means that you have paid less money to your suppliers. That's why the account grew, and therefore you have more cash in hand. And inventories is pretty logical. If you have more inventories, you pay more for those products. If you have less, then you have actually been able to sell that for cash. Then you will have the cash generated by operating activities, which is very important. Then you have cash flow from investing activities. This is sometimes referred to as CapEx, which is capital expenditures. All that money that goes to plant, property, and equipment that goes out of the business, that will fall into investing activities. And some people add up what the business has actually made from their operating activities with the investing activities, what has actually been made or invested via cash, and that will be the free cash flow. That's the cash flow that will be left over to the shareholder and also to the debt holder. And as you can see here in financing activities, you have payment for taxes, payment for dividends, repurchase of common stock, proceeds from issuance of term debt, so issuing more debt, repayments of term debt, paying the debt from previous years, and all of that added up together will be the increase in cash. And that's it. That's the basic explanation of these three financial statements and what those accounts truly mean and how you can use them. We can look at another video how to analyze even further these financial statements, but now you can read it and actually understand what the numbers mean. But remember one important thing. These three financial statements are worthless if you do not read the notes to consolidated financial statements. These notes have all the information in detail of each specific account. Most of the times, the financial statements are not complete if you don't have the notes. Even if these notes make reading financial statements longer, remember that it's supposed to be that way. This information, financial accounting, is for external users. You should take a longer time to read these things because you're investing your own money. You're trying to make money with these investments, and you have to be very careful that you are actually investing into a good business. And that's why you have to read these notes. That's why they are so important. Remember, you're trying to understand a business that probably moves billions of dollars every day. So you need to be careful of those little details that can actually give you a green or a red flag between a great investment and a bad one. Finally, these financial reports, these financial statements have to follow some guidelines. In financial accounting, those guidelines are GAAP. As anything, as the laws that guide us to live in a society, these GAAP are standards for every single company in the United States to have like a format of how to do these financial statements. And these rules are kept, maintained, and established by the Financial Accounting Standards Board, or FASB. These people make sure that the financial reports with these standards are more trustworthy and transparent to everyone, especially the external users. Well, understanding financial statements isn't just about business, it's about protecting your money. Remember Enron? Yeah, they manipulated their statements, fooled investors, and lost $74 billion before collapsing. By understanding and knowing financial accounting, you could have seen some red flags in their financial statements. Some red flags like an unusually high and increasing volume of revenue with low margins. Also, an excessive use of SPEs, special purpose entities, that are most likely used off balance. Also, you could have seen increases in debt, a slow cash flow growth, complex use of financial derivatives. If you want to sell something to somebody, if you want to make the external investor understand your business, the financial reports, instead of making it more complicated, more obfuscating, they should be clear as water, making you understand how the business is doing, what they are planning to do in the future, and that everything is pretty concise and understandable. Not like Enron, that it had an overall vagueness in their 10K reports. Fraud like this still happens today. If you don't know how to read financial statements, you could be investing in the next corporate disaster. Now that you understand financial statements, what's next? Use this knowledge to make better financial decisions, avoid scams, and build wealth the smart way. Want to learn more? Subscribe, and I'll see you in the next one. Ciao, ciao.